Good evening, everybody. My name's Chris Westcott. I'm the head of the BTRM faculty, and I'm going to give this short presentation this evening. You may submit questions online, I believe, and I will see them and I will respond to them as best as I can. Firstly, just a little bit about me and my experience. I worked for just over 30 years for the RBS group, mainly in the treasury function, but I also latterly, towards the last 2 or 3 years of my time at RBS, I ran the Basel III implementation program for the group. And that's relevant for the webinar tonight. Before I start, I think one other point that I'd make, although I'm going to talk about the practical issues with the implementation of Basel III, in many respects you can see this as a discussion on the practical issues of implementing a large regulatory project, and it doesn't necessarily need to be something like Basel III. It could be very, very different, because I think a lot of the thought processes are the same. I understand that you should be able to see what I see on the screen, so I'm just going to pop down to slide number 2, which is a picture I've used a few times in the past. And in Basel III itself is pretty much a very substantial set of measures to correct a problem with the banking system, and it was basically the problem with the banking system in 2007 and 2008. And it was felt after that financial crisis that the regulators didn't really have the right set of rules. So they went through and looked at all of the places where banks fell down, and they basically addressed them one by one. But as this slide shows, it was a little bit after the stable door. Let's move on to slide number 3. So this is just a picture of the main Basel III measures, changes. I think that the critical point is not what those changes are, other than they affect capital leverage ratio, capital buffers, some RWA changes, some liquidity changes, but really the time span. So we're seeing this chart start in 2011, and we're seeing this chart end in 2019. In fact, due to some of the rules grandfathering of capital instruments, whereby it basically takes 10 years to go from something that was counted as part of your capital base, but if it didn't meet the rule set of Basel III, then it didn't stop counting immediately. It would gradually reduce. And in fact, that kind of reduction program isn't complete until 2022. So we have a very, very long implementation timeline. And as you'll see, even now, we're probably only 2/3 of the way through that, and that's from a Basel committee perspective. So some jurisdictions are implementing this stuff quicker than others, and in some parts of the world, the process is right at the beginning. In others, countries are very well advanced. But however you look at this, it's taking a long time to adjust, and therefore, in the point I'm making in slide 4, this is not going to be a success in your organisation unless it's sponsored right at the top. And that is most likely going to be either the CFO or the CRO. I will talk a little bit later on about the costs of making all of the changes that are necessary. And I think at this stage it's worth saying a project team will not get the support that it needs for a 10-year project unless it's sponsored right at the top of the organisation. Right, on slide 5, that's are basically a high-level summary of what I'm going to talk about in total. I've broken the Basel changes down into a very high-level process and the questions that need to be solved. And as I've said already, this needn't necessarily be Basel. It could be some other set of changes. So first on this list, in the top left-hand side, is working out which rules apply in the particular jurisdiction that you work and your business is based in. I will go on in a minute and discuss a bit of detail around that. Secondly, having worked out which set of rules apply, there's a critical step in understanding what they mean. Now, that may sound obvious, but my experience has shown that you can write a sentence and give it to two different sets of people and they can get two different implications for what it means. So this is actually a really critical step, and I'll explain a little bit about what I've seen in the past as how best to deal with that. Step 3, so we've now got a set of rules. The next thing is, how do those rules compare to the rules that we are currently running our business on? And basically, if they were exactly the same, you'd have no business requirements. If they're different, then you're going to have some form of business requirement, something that you need to change. At a high level, I think the considerations around these things that need to change is it will either be a policy change, a process change, or a systems change. And whichever one of those it is will have implications in terms of cost as to how best to effect that change. So get through this part of the process, assume that we have made all the changes necessary to be compliant with the new rule set. We're at number 5. I think it's impossible to talk about something like Basel III without that little oblong shape beneath that focuses on data quality. Banks, certainly large banks, have been very poor in this area over a number of years. So I will say a few words about that. And then finally, and I'm not suggesting that you wait until you've implemented the project to consider number 6, but clearly what you should be doing on an ongoing basis is understanding what are the implications of the new rules for the business model and the returns generated for shareholders. And that may well lead to a number of changes. Okay. So on slide 6, this is a point I make often when I'm talking about Basel. I ask the question, where, in which jurisdictions are the Basel rules, or jurisdictions, which jurisdictions do the Basel rules apply in? And the basic answer to that question is they themselves don't apply anywhere. The reason I say that is the Basel framework needs to be adopted by separate legislation in each of the jurisdictions in which it applies. So in the EU, these rules are implemented by Capital Requirements Regulation, which applies to every bank and financial institution operating in the EU, or by something called Capital Requirements Directive, which is should we say, another part of the legal side of things, and this in effect gives each of the member states the ability to implement the required set of rules, so the Basel rules, by their own national law. So therefore, the requirements bit will be the same in every jurisdiction, sorry, the requirements regulation bit, whereas the requirements directive bit could technically be subtly different in each of the EU jurisdictions. So, first conclusion there is that depending on which jurisdiction you are working in or your business is based in, you may be facing a slightly different set of Basel III rules. And as I've said a number of times, if it was a different project, it would be the same conclusion. So a different part of the regulation that the regulatory standards that Basel looks at, you would have this same challenge. Right, so let's just see this with an example on slide 7. So in this case, we've got a UK group with subsidiaries in the Republic of Ireland and the USA, and a Singapore branch of the Irish subsidiary. This is not really copying any institution I'm aware of, it's just purely as an example. So if we look at the group first of all, so where I've said that this is for compliance, this could be for reporting and compliance purposes. So the group would need to comply and report based on the EU regulation per the previous slide and the UK's adoption of the Capital Requirements Directive. So that's what's happening at the group level. At the Irish subsidiary level, so it's a legal entity, so it is going to need to, well, assuming it's a legal entity that is subject to these rules, it's going to need to comply with them. And in this case, the Irish subsidiary will need to comply with the EU regulation. So that's exactly the same as the group level, but it would also need to comply with the Republic of Ireland's adoption of the Capital Requirements Directive. And that could be subtly different to the UK's adoption of the Capital Requirement Directive. The Irish subsidiary is also going to need to contribute to the group level reporting per the kind of section above. So if you're in Ireland, you've got to think about the EU regulation, the Republic of Ireland's adoption of the Capital Requirement Directive, as well as the UK's adoption of the Capital Requirements Directive. So if we now move down to the US subsidiary, the US subsidiary is going to need to comply with the US's adoption of the Basel III framework, but it's also going to need to report data and information to help the group comply. So in that instance, as has been mentioned already, it's going to need to think about the EU regulation and the UK's adoption of the Capital Requirements Directive. Finally, Singapore branch, which is possibly the most complicated of the lot. In this case, the Singapore authorities, the Monetary Authority of Singapore, may well have its own reporting requirements for branches. That may happen in the case of, say, liquidity. So that branch has got to think about the Singapore rules as well as the Irish subsidiary rules as well as the UK group rules. So potentially that could make reporting and compliance quite a complicated exercise for the Singapore branch. Okay, on slide 8, A, some challenges, and then B, a set of tips for successful implementation. So on the challenges, you probably picked up some of the, should we say, elements to think about, but also I've experienced in the past a situation where you may have a group that has adopted the Basel rules at an advanced level. So, for example, for credit risk. But the subsidiary locally is only reporting on a standardized basis. So I've seen this maybe in the case of countries like Romania. And in this instance, the operation in Romania will need to satisfy its own local reporting and compliance using the standardized rules, and then somewhere, either in Romania or centrally at the group level, there will be an advanced level calculation. So that could be just an extra challenge to all of this. So what are my tips in terms of the best way to deal with all these moving parts? So number one is you've definitely got to have a central point of control if there's a group. Otherwise, you run the risk of everybody doing their own thing. Secondly, communication. Communication is obviously key in so many of the things we do, but particularly cross-border communication. So in that instance, the Irish subsidiary, the Singapore branch, the US subsidiary, and the group, in that example, they all understand what each other is doing and how they're addressing the challenges they face. Also, the easiest way is, rather than, in our example, having 4 totally separate implementations, the easiest way to do this is, I think, to focus on the group implementation, the group approach, and then basically bolt on anything that is necessary to satisfy the rules locally. But that may not be what you choose to do in your organisation. That's just what I've seen work, and the reason why I've seen it work in the past is you tend to have the most experienced resources who work at a group level, and therefore it's probably the easiest way of doing it. It's unlikely that you will have very substantial enough resources in a small subsidiary to be able to deal with some of the stuff. Okay, to kind of add to the challenge, we find that with Basel, it's not all happening at the same time. Now, this example is taken from October 2014 on purpose, because it was a point in time where some countries were particularly advanced and others were a little further behind. So you'll see here that on the basis that green says it's done and red says it hasn't even begun to be thought about, you could find yourselves getting in a bit of a mess just because of the timing differences in implementation. And it doesn't necessarily follow that one country is quicker to implement than another. And you can see that from the example of Switzerland and US at the bottom. So while Switzerland had the systemic buffer changes, they were, should we say, well advanced in implementing those. The US hadn't begun to think about them, whereas from leverage ratio perspective, the US basically had the final rule in force, or certainly published, and Switzerland was only looking at draft regulation. So this timing difference can just add an extra level of complexity. I've only got a couple of challenges for you here, as well as the timing difference. Something that's been thrown at regulations across the globe for a very long time is there a level playing field in the regulations themselves? And I know that certainly Basel III has attempted to bring the various jurisdictions across the globe more into line with each other. I don't for one moment think that it has achieved that objective fully. Okay. So I'm now moving on to the point about interpretation. So we've worked out what set of rules apply in our jurisdiction. We now need to interpret what they mean. Now, in the UK, this certainly was a particularly complicated exercise. And the reason why it was so complex was that there wasn't one single book or publication or set of rules to refer to. There were a very large number of documents, and the rules effectively had to be pieced together from this large set of documents. So everything would start with the Basel framework, which is the top left, but as I've pointed out already, the Basel framework doesn't apply in any jurisdiction. It needs to be adopted in each jurisdiction. So that's the second box, the Capital Requirements Regulation and the Capital Requirements Directive. These weren't a one-off document. There were multiple drafts. I have, on occasion, met people who how should we say, would like to get a better understanding of the rules and have told me, well, that's easy, I'll go away and read Capital Requirements Regulation or Capital Requirements Directive. I haven't yet found anyone who's successfully got from one end of the document to the other because it's legalistic, it's complicated, and there's multiple cross-references. It is really a document to tackle subject by subject. Even if you think you're looking at the latest draft or the final document, there you'll see on the fourth little tick there, the changes called corrigenda sometimes appear at the last minute, basically to correct little errors that have been spotted in the final document. So you would always need to check that there haven't been any corrigenda that may have given a slightly different interpretation or, should we say, basically a different meaning to what's in the final document. And sometimes this can be critical because in the whole translation process, it may be that something has been given as a positive when actually it should have been a negative. So please do the following versus please do not do the following, that kind of thing. So that needs to be checked out very carefully. Then the directive part of this is adopted international law. In the UK, this was done by a document called the PRA's Policy Statement number 7 in 2013. We're not done yet because the Capital Requirements Regulation and Capital Requirements Directive, such a big area of change that when the texts were initially published, they didn't capture everything. And they knew they weren't capturing everything, so they said, the authorities that is, they said, what we'll do is we will issue some future documents giving you the detail that you're missing. And these future documents were called technical standards, and there's probably 100 or 200 of these. So quite a lot to capture in your change process. And then finally, you might think you know what you're implementing, but from time to time, organisations that aren't quite sure ask questions to the European Banking Authority, and the EBA publish answers, and it's quite possible that the answers they publish give you a different perspective on what you thought you were implementing. So those need to be picked up and looked at as well. So in the UK, if you're in charge of implementation of a change such as Basel III, you need to think about all these sets of information. Now, clearly, no one person can do that. And the way that we approached it in RBS was to set up an interpretation process. So the overall rule set will be broken down into a number of subcategories. So this might be things like credit risk, liquidity risk, market risk, so on. And we would nominate an owner for each area, and then the role of that owner would be to drive the interpretation process for that particular area, such that we would know exactly across the group how all of these different documents were being interpreted, so that we knew what the required change was. We'd also need to make sure we had someone nominated to track all of these EBA question and answers to make sure that something didn't catch us out. So that's the interpretation process. Just a little bit on governance. So obviously, with all those documents flying around that I've talked about, it's quite a significant effect on the organisation overall. So this project cannot be run as a, should we say, a single project board. So on slide 11, I've just given an example of how you might choose to break down the overall set of changes required. So not surprisingly, there'll need to be a central point, which in this case I've described as the Basel III Programme Implementation Board. That central point will be responsible for a lot of things, but let's start first of all with the arrow going up. This is to make sure that there's clear upward reporting to the senior committees and the senior management across the group. So, and that might well involve the board or the EXCO, Group Risk Committee, Group ALCO, or either other committees like Group Finance Committee or whoever controls the purse strings. Coming down a level, there will need to be a business case for the amount of change that's required. Now, you may think that that's unnecessary because this is a regulatory change and you have to comply. However, there has to be a level of discipline. Otherwise, the project will just rack up money like nobody's business. So there needs to be an investment committee or some similar type of activity to approve a business case of how much we can spend in making this change. Also, as we'll see later, if data quality is really poor across the organisation, then the likelihood is that a change like Basel III will have a possibly bigger implication than it needs to. So an understanding of the regulatory changes and where it would help to have enhanced data quality is important, and it's probably important to have a parallel work stream on improving data quality. So reporting up to the Programme Implementation Board, and again, these are just examples, but on the left-hand side, I talked about that interpretation process a few minutes ago. These rules come thick and fast. There's probably hundreds of documents. You want your Programme Implementation Board to be assured that basically everything is being dealt with in a structured way. So the Interpretation Committee would be reporting up, as would a design authority. So for systems and process changes, for a big organisation, they're not simple. They need a lot of system design and process design, and we need a central hub to check that those systems and process changes are being done effectively. I've put in here a working group. Clearly, if you've got an hour or two of senior management's time every 1, 2, 3 weeks, however often the Programme Implementation Board meets, there'll be a lot of decisions that need to be taken that basically aren't appropriate for the senior level committee. So there needs to be some form of a lower level decision forum, which I've termed here a working group. Things like Basel III, staff need to be trained, customers need to understand what the changes mean. So a communications and training forum is necessary to plan all of that activity. And then dropping down a level, the chances are, certainly if you're part of a big group, which I was, you have divisions or business units, and those divisions or business units will be themselves overseeing a number of the changes that contribute to the whole Basel III package. So they'll have their own project control committees, and the programme implementation board will obviously needs to be assured that the activities of all of those divisions or business units are all on course. Okay, so it's just an example. It will happen differently in every organisation. This is just to give you a flavour of some of the things that you need to think about. So requirements gathering on slide 12. So I've already mentioned that there's way too much here for a person or small group to deal with. So the best way of approaching this, in my view, is to break it down. So rather than looking at Basel III in its entirety, break it down into 10, 15, 20 subcategories. And an example could be things like capital, so all the capital changes, all the counterparty credit risk changes, all the leverage ratio changes, liquidity, etc. And then the task in generating a set of requirements is understand which of the new rules apply to each of those categories you've agreed, and then go through a very painstaking exercise to compare the new rules to the existing rules, which in this case would be Basel 2.5 or Basel 2, or its equivalent in EU perspective, or from a PRA or FSA perspective, as was. So once you are able to do that comparison, you can then generate, should we say, a set of changes. So what's different in the new text to the old set of text that I already worked to? And having worked out what those changes are, they can then be categorized as, to satisfy that change, do I need to do something that's from a systems perspective, from a process perspective, or from a policy perspective? And then there can be further subcategorization as to whether the change that I'm seeing, is it something that's new, or is it something that was there before and we've just changed the parameter? So that would have an implication for effectively the amount of systems work required, and indeed process or policy, because if it's new, I might need a new system built, I might need to define a new process, or I might need a new policy. Whereas if it's just a change parameter, I've got a much smaller challenge. So obviously once you've done all of this mapping, you're then in a position to set up projects for each of the changes, or maybe group some of the changes together if it makes sense. The final box here on slide 13, certainly with Basel, one of the things that I noticed and was very, very careful with is to make sure that a Basel III project doesn't spend half of its time fixing problems with Basel II. There has to be an assumption that the organisation is compliant with the existing set of rules, and Basel III will build on that. If there is a view that the organisation is not compliant with Basel II, then there needs to be a separate project focusing on Basel II remediation. If you don't do it that way, then there's a very high chance that nothing will be delivered, because there won't be sufficient focus with the project, and the project will drift, because half the project team's trying to deal with the changes from Basel III, and the other half's got an eye on the failings of Basel II. Okay, so assuming that we've got as far as generating a set of business requirements and we understand which ones are systems, which ones are process, and which ones are policy, from a systems change perspective, there's just a few comments that I have around the point in time where you change all the systems. So those of you who work with regulatory rules will be aware that banks need to be compliant with them at all times. Well, from all practical perspectives, that's pretty difficult with things like the Basel rules, because firstly, let's take when would we like the rules to change? Well, we would actually like the rules to change on the 1st of January, please. And the reason I say that is because organisations that need to report need to provide comparatives, and it's very difficult to provide comparatives according to a different set of regulatory rules. Also, a challenge is that most organisations can't have more than one production system in operation at any one time. So we'd like the changes on the 1st of January, which, by the way, most instances, that is when the authorities do make the changes, most but not all. That will help us from the perspective of prior year comparisons and things like that. Obviously, banks run their year-end positions and then probably make a series of adjustments after the year-end, and therefore it's not going to work, even if the rules are implemented on the 1st of January, for the systems cut over from old rules to new rules to also happen on the 1st of January. In practice, it's probably going to happen maybe 10 days after the 1st of January. That gives an organisation basically a chance to close 1 year and start focusing on the new year. And with that cutover slightly after the year end, it means that the old reporting for relating to the previous rules can be done correctly, and then there can be focus on the new rules. So most organisations technically probably aren't completely compliant with a rule change that even takes effect on the 1st of January. Obviously, if it's a trading book situation, then reporting there is going to be done every day, and in that instance, the cutover, the systems cutover, or certainly the calculation under the new rules is going to need to be performed from the 1st of January. And actually, what I've just said there is summarised on slide 15. So let's just make a few comments about costs. I was actually amazed, but only initially amazed, as to basically how much it would cost to make a change like Basel III. And what I've done here is I've just, on slide 16, put some of the categories that need to be captured as you're building the business case for the change. First, very few business cases did I see the end level estimate as how much it would cost being lower than the initial estimate. There's a tendency to go low and then realise all the extra things you need to change when the project's well advanced. And you can see that with just look at Olympic projects and World Cups and what have you. Normally there's an assessment that it'll cost, I can't remember the exact numbers in the UK, but it was hundreds of millions or a low level number of billions, and it finished up costing 2 or 3 times that amount. Well, it's exactly the same with a large regulatory project. So as senior management are approached initially, you've always got to have some thought for those elements that will need changing that you haven't managed to think about at the point that you're making the application to senior management. And the types of areas are obviously systems changes, data quality, program management. Someone's got to run the project side of this, reporting infrastructure. In regulatory project terms, there's a lot of these quantitative impact studies. That probably requires additional resources to conduct those, and some got to be budgeted somewhere. As well as systems changes being to existing calculations. They're the simple ones. You've also got new calculations to set up. Might be new policies required. So Basel has been quite hard on HR remuneration and put some constraints on basically how much the banking world can pay itself. Restructure of capital instruments. That, because it requires a lot of legal resource, is a costly item. And then there's training and education. Now I've just put down a small number of the possible items that could lead to a cost, but I assure you there's a lot. And I think we come on to, on the next slide, just roughly how much Basel III implementation would cost a large organisation. So you'll see there in the middle dot point, could well be in excess of £100 million. So, go right back to the beginning, my comment that a project of this nature must be sponsored from the top of the organisation. Well, clearly, if you're spending £100 million, there's no way you'll get the budget unless it is sponsored right at the top. And clearly, in the knowledge, or once you've understood that it's going to cost a sum like this, there's a huge amount of governance to get the necessary approval in place across the whole organisation. And certainly in where I worked, there might have been 40 executives or thereabouts to be comfortable with the changes that were being implemented, and it was necessary to get those 40 executives happy, because the CFO, for example, one of the questions he would ask is, are the 40 executives who report into me one way or another, are they all comfortable with the changes and certain that this is being implemented in the most efficient way? So the cost side cannot be ignored, even if it is a regulatory project and compliance is mandatory. So data completeness and accuracy. I think many organisations will focus on this last, and all of the work will go into ensuring that the correct calculations are happening. Now that's great, but if the correct calculations happen on the wrong data, it'll be the wrong answer. And that, in regulatory terms, tends to hit banks pretty hard. So on slide 19, I've just put some of the consequences of having poor data quality. So firstly, if you've got null values or gaps completely, the assumption generally is you have to take the worst case outcome. So that will, one way or another, lead to an overstatement of the risk that's being run and an overstatement of the capital that the organisation is required to hold. Alternatively, if all the data inputs are just inaccurate one way or another, so they're not nil values, they're just not the right values, then the wrong risk calculation is going to happen, and there could be some systematic bias to the end result. Any regulator seeing this or getting a feel that that is the case in your organisation, is going to be encouraged to put in some kind of supervisory overlay, and that might come from either the ICAP process or the ILAP process, and I have seen cases where those overlays have been applied in the past. So how do you avoid all of this? Well, clearly, early, you need to understand what the key data items are, and basically, you've seen how long it takes to implement Basel III from end to end. At the beginning, start thinking about if you've got any serious data weaknesses and start doing something about them early. We're helped a little bit in this by some of the other ongoing regulatory changes around risk data aggregation. So moving on to, so we've implemented everything, we've got all the right calculations, we've changed all the processes, we've changed all the systems, we've done it all within budget. Clearly, one of the things that we should have started thinking about right at the beginning of this journey is what is the implication of the new set of regulatory rules for our use of balance sheet resources. Now, in the case of Basel, this is, should we say, it's easy insofar as virtually everything is making life more difficult for those balance sheet resources. So, for example, the new CVA charge and the asset value correlation, they lead to a higher level of RWAs. All of the capital changes lead to a higher level of required capital. The new liquidity measures significantly increase the liquid assets required by banks, and the leverage ratio, if not restrictive at the group level, is in many instances restrictive to organisations at a subsidiary level. So we can conclude that balance sheet resources are scarcer than ever, and that, you know, that may well be the case with other regulatory changes. So if that, rather than just accept it, banks need to be thinking about strategic plans to basically address these rule changes in the most efficient way. So if we look at slide 23, there are a number of ways of tackling this. So number one, you might need more of those balance sheet resources. So for example, on liquid assets, I think it would not be uncommon for banks to have tripled the amount of liquid assets they were holding if we do a before the financial crisis and after the financial crisis comparison. Likewise with capital, by the time we get to the end of the journey, I know we're only partway through it, but at the beginning of the journey, total capital ratios may well have been close to 10%. At the end of the journey, those total capital ratios are going to be nearer to 20% versus RWAs. So part of the mitigation is you just need more of some of these balance sheet resources. Clearly, one way of reducing the burden is to try and decrease the risk. And a number of possible ways this may be done. Possibly, more sophisticated calculation methodologies could be adopted. Now, I say possibly because that's maybe not as easy as it might sound to achieve. More likely is that organisations will decrease the risk either from hedging, so maybe purchasing cover through CDS, or just exiting business lines, just getting out of particular lines of business which consume a lot of balance sheet resources. So an example, very long-term lending with derivatives attached does not sit very well in Basel III world, and you've seen organisations trying to move away from that type of activity. and under redesign the customer offering. So in some instances, rather than having a 30-year loan to a customer with derivatives attached, it might make sense to speak to the customer and see if that can be negotiated to a shorter time commitment, possibly with a payment in the customer's favour, but that nevertheless might turn out to be a position for the bank that consumes a lot less capital. We've got redesign of products, so from a liquidity perspective, there was a time when banks became very keen on 35-day notice accounts, the reason being that those accounts would not necessarily be caught by the liquidity coverage ratio, which is one of the Basel III changes. Product pricing, if everything's going against you, then in some cases, some of the burden may be passed on to the customer. And again, under redesigning the customer offering, there may be certain types of customers you no longer wish to be associated with. And then obviously there's more efficiency in the management of the balance sheet, and that could be from the data collection and data quality, or organisations needing to look at their corporate structure. The way Basel III works is that very large banking groups operating across multiple jurisdictions find life particularly difficult under this set of rules. So finding some way of reducing the number of legal entities, the number of jurisdictions, can be beneficial from just the perspective of coping with the Basel III rules. So I've gone on for about 50 minutes or so. I hope you've found some of what I've said informative and useful to you. If you've any questions on anything I've said, you can ask me now, or if you don't want to do that, you can send a question to me. You'll see my email address there, and if you don't want to do that, you can always contact the BTRM team centrally, who can feed anything on to me. So I'll just give you a minute or so, and if you've anything you want to ask now, please do. If not, thank you ever so much for your time, for listening, and I hope to see some of you soon. Okay, so I think we're going to call it to a close here. Thank you, and as I said, I will speak to you soon. Thank you. Bye-bye.